About to begin our afternoon session. Before the panel begins, though, I would like to invite Mr. Feng Yao, Executive Vice Chairman of the China Association for Public Companies, to the stage for a special address of the day. In the meantime, I'd like to make an announcement. Those of you who will be listening to the interpreting services, channel number 2 is English and channel number 3 is Chinese. Thank you. Mr. Feng, Mr. Yao, the floor is yours, sir.
女士们、先生们，下午好！非常感谢会议主办方邀请我参加此次论坛。我是中国上市公司协会执行副会长姚峰。中国证监会主席肖钢先生因重要公务未能应邀前来演讲，他对本次会议十分关注，指派我前来参会。借此机会， 我向各位简要介绍一下中国公司治理发展的现状和未来的工作设想。首先，我简要介绍一下中国资本市场的情况。经过20多年的发展，中国已经初步建立了多层次的资本市场体系。在股票市场上，有主板、中小板、创业板、 全国中小企业股转公司等4个板块。2014年，企业通过股票市场共融资750亿美元，比2013年增加了70%。2014年，股票市场总市值6.1万亿美元，为中国 GDP 的58.37%。 下面我们一起简单回顾一下中国公司治理的发展历史。中国的公司治理制度是在国有企业改革和股份制企业发展过程中逐步得以探索和建立的。在此过程中，我们积极参考、借鉴了包括 OECD 在内的国际组织和其他国家的先进经验，比如建立独立董事 制度等等。经过20多年的努力，中国已基本建立了较为健全的公司治理法律法规体系，企业公司治理的质量和水平有了显著的提高。特别是作为公众公司的上市公司，政府相关部门和证券监管部门对其公司治理提出了更高的要求，其公司治理质量 较其他类型的企业平均水平更高。自2002年，中国证监会和中国国家经贸委联合发布《上市公司治理准则》开始，经过10多年的发展，目前以信息披露为基础的市场监督机制和以市场为导向的公司治理外部约束机制已初步形成。 同时，根据中国的企业文化和股权特点，在国际通用的公司治理基本原则的框架下，形成了具有中国特色的公司治理结构，如同时设置监事会和独立董事，强化外部审计和内控体系建设等。在实践中，股东会、董事会、监事会 经理层相互制衡、协同合作，使公司管理水平和经营质量得到了不断提高。信息披露逐步规范，有效地保护了股东、投资者，特别是中小投资者的利益。曾经困扰中国资本市场发展的上市公司大股东与上市公司关系不清、大股东资金侵占问题 得到了较好的解决，但是由于中国的公司治理实践，无论是当初的制度建立，还是后续的改革完善，都是政府导向行为，企业自主、自愿参与的程度不高，这造成了有些公司治理的细节规定不太适合企业的具体情况和实际需求， 还需要进一步的优化和完善。20多年的工作实践让我们意识到，公司治理具有显著的个性化特征。在基本的原则框架下，具体实现上并没有通用的标准和模式。不同规模、不同股权结构、不同发展阶段、不同文化特点的公司，在公司治理的实现路径上，并不存在统一的最优不二的做法。上市公司治理应该更加具有包容性、开放性和多样性。只有根据企业自身实际量身定制，才能够建立起符合企业自身发展需要的、对公司运营发展更为有效的治理结构和运行机制。中国上市公司治理监管的金字塔架构包含了3个层次。首先是由于顶层的中国证监会来负责整体的制度设计以及出台相应的法规文件。由于相当数量的上市公司具有国资背景，因此居于监管体系第2层的相关政府机构，如财政部、国资委等等，也会针对含有国有股份的上市公司出台管理规定。证券交易所和证券登记结算公司作为资本市场的自律组织，处于监管体系的第3层。沪深交易所、证券登记结算公司依据证监会以及相关部门的法规文件，结合自身特点出台公司治理的自律性规范文件，所有上市公司都被要求遵照执行。我现在所代表的中国上市公司协会不是上市公司的监管部门，但是自从协会成立以来，在中国上市公司治理的整个体系中，中国上市公司协会正在发挥日益重要的、不可或缺的作用。各位肯定注意到了，中国本届政府提出简政放权、完善社会治理的大背景下，18届3中全会要求建设新型的社团组织，承接监管机构权力的转移，推动市场监管体系转型，为类似中国上市公司协会这样的社会组织提供了巨大的发展空间。为了进一步提高上市公司治理的针对性、有效性，中国证监会决定由中上协主要负责今后上市公司治理制度的推进完善工作。借此机会，我简单介绍一下中国上市公司协会。中上协是2012年2月经中国国务院批准设立的，是以上市公司和相关机构为主体，以统一的资本市场规范为纽带，以维护会员共同合法权益为目标而结成的全国性自律组织。中国证监会是中国上市公司协会的业务主管部门，协会的主要工作职责是以服务、自律、规范、提高为宗旨，搭建上市公司交流平台，传递政府政策信息，推动政企对话，引导上市公司改善公司治理，履行社会责任，建立良好的公司文化，不断规范运作水平和公司质量。截止2015年3月底，在协会注册的上市公司会员有1740家，占全部中国境内上市公司总数的65%。会员公司总市值为6.6万亿美元，约占中国境内上市公司总市值的85%。由此可见，协会在中国境内上市公司中具有很高的代表性。中上协虽然历史不长，但是成立3年来，在促进上市公司完善公司治理方面，已经进行了一系列的探索和实践。为了提高上市公司治理的有效性、适应性和科学性，2012年8月，中上协发起了倡导独立董事监事最佳实践活动，通过征集案例、交流研讨、培训传导、 调查研究、总结推广等形式，发动上市公司奉献、分享、借鉴独立董事、监事会行之有效的做法和经验，通过相互交流、互相学习，来共同提升公司治理的水平。在总结活动的基础上，协会撰写出版了《中国上市公司治理报告》，针对独立董事、监事会、外部审计和内控、机构投资者、控股股东和上市公司监管制度等6个方面，提出了改善中国上市公司治理的意见和建议。出台上市公司高管人员的工作指引和行为规范，构建公司治理的自律规范体系，是协会的一项重要工作。为了指导上市公司独立董事和监事会更加充分、规范、有效地履职，更好地发挥作用，2013年和2014年，我们分别编写了上市公司独立董事履职指引和上市公司监事会工作指引，并根据对上市公司独立董事、监事会的全面调查，撰写了上市公司独立董事履职情况报告和上市公司监事会履职情况报告，分别对中国上市公司独立董事、监事会制度的运行和现状、实施的效果、存在的问题进行了分析和评估，对进一步完善相关制度提出了建议和设想。接下来，我们将继续编写上市公司董事会工作指引等一系列的上市公司相关主体的工作指引。此外，协会还围绕上市公司的现实需求，继续加强上市公司治理的理论研究和实践探索，加强与国际组织及境外相关治理机构、非营利组织就公司治理专题加强交流与合作，进一步完善中国上市公司治理的结构，提高中国上市公司治理的水平。我们希望通过中西结合，在实践中逐步形成有中国特色的上市公司治理理论体系和符合中国情况的上市公司治理的制度。前面我已经提到过，中国上市公司治理准则的制定借鉴了 OECD 的公司治理准则。2009年，在 OECD 帮助下，中国证监会与 OECD 合作启动了 OECD 中国公司治理共同评估项目。中国证监会完成了自评估报告， OECD 公司治理委员会对自评估报告进行了讨论，并提出了反馈意见。双方合作的成果见诸于公开出版发行的《中国上市公司治理发展报告》（OECD 中国公司治理共同评估项目自评估）。该中英文双语的自评估报告全面阐述了截止2009年时中国公司治理的情况。世界变化很快，中国的上市公司在公司治理方面也呈现出新的趋势。今天我带了几本中上协去年编写发行的2014版中国上市公司治理报告，补充了近几年中国上市公司治理的情况，并提出了改善公司治理的意见和建议。遗憾的是，还没来得及完成英文版的报告，我们为本次论坛专门提供了一份英文材料，是报告序言的译文，希望大家能从中了解报告的主要内容和结论。女士们、先生们，借此机会，请允许我就本次 OECD 公司治理原则的修订工作谈一点个人的见解。首先，感谢 OECD 公司治理委员会以及各相关方在修订准则方面做出的不懈努力和显著的贡献。OECD 公司治理原则发布于1999年，于2004年首次修订。16年来，这些原则虽然没有法律约束力，但是在指导各国完善相关法律框架、 上市公司监管以及公司治理机制，促进全球经济更有效、稳定、可持续发展方面做出了巨大的贡献。结合情况的变化，对于这些原则进行及时的修改，意义重大。其次，我本人非常同意 OECD 在本次原则修订起草说明中的表述：公司治理不存在唯一的最佳模式，但是优秀的公司治理也存在一些共同的元素。我相信，这次修改后的 OECD 公司治理原则应该建立在上述这些共同元素之上，并且可以包含现存的不同类型的公司治理模式。例如，以中国为代表的新兴市场，近年来在公司治理方面有很多符合当地情况的最佳实践，也面临着一些问题。建议本次 OECD 原则修订过程中予以足够的关注，以便进一步丰富公司治理准则的内容，增强准则对新兴市场的影响力和适用性，防范公司治理方面的重大风险。第三，我希望中国公司治理实践的发展和法律体系的不断完善，可以为世界各国公司治理提供有益的借鉴，对于培育市场信心、中国企业走向世界以及各国企业投资中国，都具有积极的意义。我们愿意结合自己的具体国情，吸纳百川，借鉴学习，也愿意为促进国际投资的稳健发展积极贡献我们的力量。再次感谢大会的邀请，中国上市公司协会愿意与 OECD 等国际组织以及各个国家的相关组织加强合作、交流、分享工作经验，共同促进上市公司治理水平的提高。谢谢大家。Thank you very much.
We thank you, Mr. Yeo. Distinguished participants, our second panel is about to start with the corporate governance and value creation, institutionalization of growth companies and SMEs. In order to chair this session, I'd like to invite Mr. Mats Isaksen, Head of Corporate Affairs Division of the OECD. And our panelists, if you could come to the stage, please, as well. Mr. Gabriele Galateri Di Genola, Chairman of the Generali Group, former CEO of Fiat. Mr. Hideki Kanda, Professor of Law of the University of Tokyo. Mr. John Plender, Senior Columnist of the Financial Times. Mr. David Weld, Chairman and CEO of Isu Works, former Vice Chair of the Nasdaq Stock Market. And Mr. Zhou Hui Chen, Vice Director of the SME Board Disclosure and Compliance, Shenzhen Stock Exchange.
So this microphone is on. Well, welcome back after lunch, everybody, which was in all senses delicious, with a wonderful view of the Bosphorus, a shining weather and glorious food, and not least excellent company, which we all enjoy. I am particularly privileged to be with a very distinguished panel up here. Maybe I will start with, I'll present them very briefly. If you want to read their bios, you can do so, but if I were to read them, it would take the entire session. So I just briefly present my friend David Wild, sometimes called the father of the US Jobs Act, which is a big job up the Capitol Hill to improve IPO conditions for growth companies. Next to David is Professor Kanda from Tokyo University, a well-known company law scholar and instrumental in the last year's effort in Japan to develop a new corporate governance code, but previous to that also improvements in the company law. We know that Japan, in particular, struggles with a bit of a challenge when it comes to entrepreneurship and growth companies. So it will be very useful to have Professor Kanda on the panel. In the middle, we have the origin of corporate governance, namely the United Kingdom, because this is really where I think John and Sir Adrian Cadbury in the late 80s and early 90s coined the term and issued the Cadbury Code. And John has been working on the issue ever since in various capacities, and not least as a trustee of a big pension fund, I think it is, and also in various companies. Next to John is Mr. Gabriele Galateri. And you may ask yourself, what does the former CEO of Fiat do on a panel on SMEs? I mean, the cars may be small, but the company is huge. And currently he's also the chair of Generali, another giant company. But I can tell you that Gabriele is a notorious entrepreneur who is constantly involved in technology initiatives with small companies. He is also on the board of Lavazza, which is a non-listed family company, which I think has very, very relevant experiences for this session on small and medium-sized enterprises. And last but not least, we have a new friend of mine, Mr. Chen, from the Shenzhen Stock Exchange in China, who will be able to share with us something of a success story. I will not take up too much time. The only thing I want to do is that I want to just maybe elaborate a little bit about the title of this session, which is a bit, I admit, it's not extremely clear in all respects. It is about corporate governance and value creation. Well, we can understand that. And then it says institutionalization of growth companies and SMEs. What does that mean? I admit it's an unnecessary, awkward term, basically for saying that what we want to look at in the G20 OECD context is how corporate governance and corporate governance improvements and how improvements in market structures can help small and medium-sized enterprises to get access to capital. Because we know, not least from studies in Turkey, that the more formal a company becomes in terms of accounting and also in governance structures, the more productive it becomes. And this is a real challenge, not least in a lot of emerging markets, to take companies from the informal sector to the formal sector. And we believe that governance, accounting, disclosure, and all of these things play a role in that. The question, I think, before the House is, where is the middle ground in terms of scaling, in terms of proportionality that we discussed this morning? But these gentlemen will help us to crack that nut and come to a good conclusion on where a good middle ground is to achieve this. And I will let the way we'll run it is that everybody will do a 3 to 5 minute opening thing about the most urgent things they want to say. Then we have a little bit of questions and a possibility to come back on questions that I may have to you. And I propose to do it just as you appear in the agenda, which means that Mr. Galateri would kick off. So, Gabriele, the word is yours.
Okay, thank you very much. Well, first of all, thank you for inviting me here. It's fantastic to be in Istanbul, to have this possibility to hear so many interesting things here this morning. Which I just make one comment for this morning session. I mean, I think that there were so many interesting items being said that in one way, this session and in general the OECD work on corporate governance should become more vocal. I mean, people should know more about our discussions, particularly non-technicians, because here we talk about people that know quite well the subject. I think that in order to have the kind of objective that you have indicated, we need also the public opinion to understand what the governance means. Because my basic worry, being a chairman of the Italian Corporate Governance Committee, but also chairman, as Matt said, of Generali, which is by no way a small, medium enterprise, and also of this institute, Italian Institute of Technology, I think that the concept, the basic concept we have to achieve is that corporate governance is not what I think the word in English is correct, a straitjacket, but it is a development instrument. It is a normal way to manage correctly companies. So starting from a little bit far away, I mean, my view is that we are still in a moment of difficulty around the world in OECD and G20 countries, because we know that no matter if the financial crisis seems to be over, but the economies are still stagnant, unemployment is very high, so we do need to invest, we do need to make innovation, we do need to have efficient and liquid capital markets. In one word, we need the governance as a bridge between companies, investors, and markets at large. Growth is the name of the game, and this is particularly true for small and medium-sized companies, because let's be frank, they are the backbone of the European economies. And it is particularly important in a country like Italy, where small and medium-sized companies are really the large part of the industrial and the commercial scenery of our country. Now, often in Italy, the rumor or the comment that we hear today is banks are not extending credit to these companies. Companies don't get credit from banks, and so we are in trouble. How can we solve this problem? Well, my opinion, I don't want to be too determined, but my opinion is that this is not very true. I've been sitting also in the board of banks, small banks, big banks, and frankly I was rather impressed when the dossier of the small medium enterprises came to the board. I mean, it was frankly impossible to extend credit to those companies. Let's be frank. I mean, dossier that had such a kind of information that was absolutely inadequate, and still companies and banks at that time were giving credit. So this is why now we have so many bad credits to put out of the banks in order to restore some equilibrium. And this is why, because companies, particularly I'm talking about small and medium enterprises, do not present sufficiently transparent financial and economic statements and do not have enough of a minimum of corporate governance. So let's talk about corporate governance, and particularly in Italy. Corporate governance, I don't need to tell it to you here, but it is a set of rules, mandatory regulations, and best practices. Good governance brings normally good companies with well development. Bad governance brings problems to the companies. There is not a mathematical exercise that states that a company that does well has a very good governance, or companies that do badly, this I can say, yes, they have a very bad governance. In Italy, the code started, together with your principles in 1999. It was made by a commission that, by the way, I was not chairing at the time, but I was a member, made, this is interesting, by association of industrialists, insurers, bankers, stock exchange, and the association of the investors. And it was built on three main principles, the ones that you mentioned for EDC: effectiveness of the board, so the board has to be the central body of the company, indicating the strategy and indicating, this is one element that I heard with pleasure this morning, the risk appetite that the company can have. Second, independence, because it is quite important to define when a director is independent or is not an independent. And third, the accountability. I mean, the board has to define, the company has to indicate what kind of model of governance it wants to follow and what is the relationship between management remuneration, objectives, and so on. But the Italian code, in particular, in my opinion, has two characteristics that are, frequently said, but not necessarily frequently applied. One is that famous comply or explain principle. But in the last revision of the code that took place in 2014, we insisted in underlying inside the code that not complying but explaining was by no means a negative element of evaluation of the company. So companies should have felt free that if they could not or did not want to comply with the principle for reasons I could explain, because they were coming out of an IPO, because they were small and so on, they were not forced to apply those principles. The second was what you mentioned again this morning, the proportionality, in the sense that several principles were calibrated so that small companies, medium companies didn't need to go through all the burden. For example, not necessarily all the committees, not necessarily the lead independent director, not necessarily a certain amount of independent directors. So all this created a situation by which even medium-sized companies didn't felt that element of scare or of worry. And the proof, as I mentioned to you and you recalled now, is that some medium companies, like the one that you mentioned before, Lavazza, that you might know because it's in Italy at least a famous brand of coffee in which I'm sitting in the board, fully owned by a family called Lavazza, 100%, decided at one point in time to introduce 3 independent directors, including myself, on a board of 7, in order to get outside judgment on their way of managing the business. But not only, I was extremely surprised when one day they called on us and they said, look, but we would like to establish a remuneration committee made out of you 3 independent. I was rather impressed because, as I said, I'm chairman of the governance committee of the Stock Exchange. I mean, having these things applied to large corporations and so on was not obvious. These people, out of the blue, without being pressured in any way, asked us to do so because they recognized that it was a good way to deal on that subject with management and with themselves. And it functions quite well. Another company that is introducing, has introduced since a long time independent directors is the famous textile company Zegna, which is another medium company. So my view is that we have to be flexible, we have to be calibrated in terms of these principles, and then the other main subjects I underline, and then I stop in a few seconds, is education of people, as you mentioned already. I mean, all these people that I mentioned, the Zegna, the Lavazza, were people that had the culture to understand that governance is not a law imposed by some strange body sitting in Basel or in Washington or wherever it was, but it is a normal way, a normal instrument to run companies. So in Italy there are 2 applications I want still to quote because they seem to be interesting. This stock exchange has developed a segment of its activities, an information platform called Elite. It's a platform in which companies, medium-sized, find advisors, counterparts from the industrial world, bankers that inform them, engage with them in order to explain, how you can confront the challenges of the international markets. So not necessarily these companies will end up listed, but learn how to be well managed. And it is such a success that now the Italian Stock Exchange, together with the LSE, is thinking of extending this platform to the European base. The last comment I would like to make to show how governance is important for growth and for medium companies and small companies is that in that Institute of Italian Technology that is really exploding and moving ahead quite strongly, we have a lot of spin-offs and startups that come out of the analysis. At one point in time we decided that close to the scientists that are making the inventions and the discoveries, we needed at the same time to have courses and formation in terms of management, in terms of governance, in terms of how you make a plan, and we called even a Nobel Prize, Michael Spence, that is coming there together with other teachers and professors, so that our scientists that want to become entrepreneurs learn from the beginning that it is not enough to have a good idea, a good product, or a good market. You need also to understand how these things are managed, so that it becomes normal to have those rules, and it is not something that you have to undergo only because you want to be listed or because some strange faraway organization forces you to have them.
Thank you very much. No, it makes sense. Somebody told me that you should actually invent your product or sell your product first, and then you invent it when you know there is a market. Professor Kanda, please, the floor is yours.
Thank you very much. It's a great honor to be here today. Just a few words about what's going on in Japan right now. The corporate governance code is just about to take off. The code will be effective from the 1st of June this year as a part of the listing standards at Tokyo Stock Exchange. I'm a member of the committee at the FSA, and Max Isaacson is a special advisor to the committee. I'm also a chairman on the advisory group on listing system of the Tokyo Stock Exchange. The code includes 73 principles, many. The implementation will be expected to be made in the methodology of what we call comply or explain. That's more or less a soft law approach rather than the complying only approach. The code puts emphasis on the growth, value creation, and so forth, that has been emphasized by Mats, and in that sense, we believe that this corporate governance is very important, and the capital market is important, and I'm very much satisfied with the new proposal OECD principles, creating one chapter devoted to the capital markets, institutional investors, and so forth. I would like to focus on IPOs and try to explain on the basis of my experience. There are both good IPOs and bad IPOs, if I may say so. Good meaning value creating and growth companies, bad may mean value is not creating, only the value diversion takes place from, let's say, public shareholders to the controlling shareholders. I think the good example, to my mind, there is a small company called Cyberdyne, Japanese company, Cyberdyne. This is a manufacturer of robot technology, and this company got listed on Tokyo Stock Exchange about a year ago, in March last year. For the first time in the history of Tokyo Stock Exchange, the Tokyo Stock Exchange did permit the IPOs and listing. Despite that, the founder of the company keeps 85% of their voting share. That is to say, this listed company has no possibility for its control to be transferred unless this founder sells his controlling block. The remaining 15% voting shares are traded in the trading markets on Tokyo Stock Exchange. You may recall that whether we should permit listing of this structure, it's a very sometimes known as dual class voting structure. In the United States, for example, Google, Facebook, Alibaba, all these structure. But only when the new company gets listed, the stock exchanges in the United States does permit this structure. In other words, if you're already listed companies and you want to issue a controlling block to a particular person, that behavior usually is not permitted. Talking back to Tokyo Stock Exchange, I think that this company is a great company, and it's a good story in the sense that the small company is a growth company, value is created, and so forth. Now, the newspaper reports whether the Tokyo Stock Exchange does recognize similar listing for companies like Google, Facebook, and Alibaba, and so forth. There is a company called Line, L-I-N-E, very well-known software for mobile companies, and they have a company in Japan, but the controlling shareholders is located in South Korea. The line, the newspaper says, has been applied for listing on Tokyo Stock Exchange in the past 2 years, and they are still discussing the matter. I mentioned this. What is the key question? The key question is governance. Indeed, in talking back to the Cyberdyne, the Tokyo Stock Exchange put a special governance requirements in order to prevent possible abuse in the future, and in order to align their managers and management to the growth. And therefore, I think that the Tokyo Stock Exchange position is to put the governance conditions whenever this type of new companies are just applied for listing. But I gave this as a good example. Then I wouldn't say bad examples, but there are some examples that I think are controversial on my experience in Japan and other countries. There are two examples. One is where IPOs are not quite IPOs. It's not the initial public offering, but rather last public offering. It's the initial public offering, but at the same time, it turns out to be the last public offering. That is to say, the small company gets listed, and then they do nothing for 10 years or even more than 10 years. One might argue that, well, it may be bad management and it may be unlucky, but they do not raise any further funds, but they do not do any other things. The trading market is very thin. I'm not very sure that whether these IPOs are good IPOs, value creating, and so forth. The second example is the part of the MBO transactions that you are familiar with. The MBO transactions take place that these listing companies go private, excuse me, and then 4 or 5 years later, they make IPO. But this IPO is not the initial and the beginning of their company. Indeed, very much, very often it means the end of the company from the perspective of the supply of the capital, private equity funds and some other financial institutions. Because the company go private and they go public again. Once again, I'm not saying this is bad per se, but in certain transactions, they go private, let's say at the price of 10 euro per share, and 4 years later, they go public at 40 euro per share. If it reflects the substance, that is the value creation, that's very fine. But very often the case that after they go the second IPO, so to speak, the price goes down, or alternatively, just before they go private, the price was very high, the price went down, and they went private. There must be something going on. Value creation may not take place. Instead, what's happening is just the diversion of value from public shareholders to the controlling shareholder. If that is the case, I think as a policy implication, we should discourage such transactions. So there are both good IPOs and bad IPOs, and the role of the policy is to try to encourage good IPOs, value creating, whereas we should probably discourage bad IPOs where if no value is creating and only value diversion from public shareholders to the controlling shareholders takes place. Now, how? Well, I think the governance is the key. And the OECD principles already provide some suggestion. One is to enhance the dialogue or engagement between the company and the shareholders. That is very important. Also, that is the point emphasized in the Japanese code. And the second point, indeed, I think that is briefly touched upon in the morning session, that is the difference between the listed companies and non-listed companies. The world today is not like small company, young companies just growing up, whereas the large company just standing, keep listed. What's happening is large companies go back and forth between public market and private market. They go private, they go public and private and public again. So the public capital market and private capital market continuous rather than discrete. That is to say, I think that this corporate governance principles should apply not only where they are listed, but also after they go private, and because they are expected to come back and go public again. That is the second implication for the policy. I will stop here. Thank you very much.
Thank you very much, Hideki, for those comments. I think I'd like to turn to John.
Thank you, Mats.
And one of the things that I I would like you to, considering that you don't have any genuine IPOs in the UK anymore, does that really matter? I mean, can't you just enjoy the private equity and venture capital industry? That is one of the questions that are we focusing too much on the IPOs rather than the existence of venture capital and other forms of financing for corporations?
That is indeed a very good question, which I'll come to. But may I kick off just by talking about IPOs more generally? It seems to me that everybody recognizes or thinks that there is a problem with the global IPO market. And indeed, Mats and his colleague, Serdar Celik, have done a marvelous paper for the OECD looking at all the data on IPOs around the world. And it's very clear that something's going wrong, that their number and value has diminished. But in order to diagnose the nature of the problem, it's not easy. And the reason is that there are so many distorting factors, starting with two huge stock market crashes over the past 15 years. And if you look back to 2000 and the dot-com bubble, before the thing peaked in 2000, you had a tremendous bunching of investment before that. And so when the market crashed, there was a drought of investment and of IPOs. And then just as things were picking up again, you had this enormous financial crisis, biggest recession since the 1930s. And understandably enough, there's been a huge loss of risk appetite. And over the past 6 years, it's scarcely surprising that there have been relatively few IPOs because, we've been trying to get out of a massive recession, at the same time coping with a huge overhang of debt. So, and then on top of that, you've got another vast distorting factor in the market, which is this central bank intervention, quantitative easing, all these unconventional central bank measures, plus a glut of savings around the world, which has driven bond yields down to an unbelievably low level. So the natural relationship between bonds and equities is distorted. I put it to you that I don't think anybody in this room can have a real idea of what the normal level of IPOs in terms of volume and value should be. It's just impossible to know. But I think the one thing that a lot of us could agree on is that there is a problem for SMEs. I don't know anybody who thinks that there aren't problems for SMEs in terms of accessing public markets. So I hope that that is something that we could all agree on. Now, when one thinks about how you address those kinds of problems, there's one very helpful thing going on at the moment which relates to what central banks have been doing, which is that the whole purpose of QE is to try and persuade people to take on more risk, to get investors to increase their risk appetite. And that ought to be helpful in terms of getting people to put money into primary equity markets. But the trouble is that there are structural headwinds of a very marked kind, both on the demand side and the supply side. And I'll focus mainly on the demand side, because I know that David Wield is going to talk a lot about the supply side constraints. But if you look at the innovations and the structural changes that have been going on in markets and on exchanges over the past 50 years or so, most of them have been extremely unhelpful to smaller companies. There's been the institutionalization of investment, the channeling of more and more money into collective investment pots like mutual funds, pension funds, and so forth. And if you have money aggregated in that way, it simply isn't cost effective for those institutions to go to the bottom of the market, which is relatively illiquid. They can't affect the returns on these vast portfolios by dabbling around at the bottom of the market, which is where the smaller companies ought to be coming in. So that's a problem. And the same thing applies to the globalization of capital flows, which we've seen. Global capital is looking for big liquid investments. It's not interested in what is going on below the very sort of big end of the market. And at the same time, all those things like indexation and the arrival of exchange-traded funds are also reducing the liquidity for smaller companies. They're not very helpful for people who are thinking about floating. I mean, to think about floating where you might end up in an ETF, but at the same time have a free float, which is illiquid and very volatile, is not a terribly tempting prospect for entrepreneurs thinking about going public. And then, of course, you've got sort of high-frequency traders. Same thing. I mean, they're fair weather market makers. In effect, they increase liquidity at the top of the market. They're not interested in anything down below, and they also gave us the flash crash. So I think that what that tells you is that the structure of ownership is very unhelpful now for smaller companies. And but then let me turn a little bit to Mats's point about whether it matters if you don't have a vibrant IPO market. And I think that actually, if you look at those areas where there still is a vibrant IPO market, let's say the US, it's very apparent that what IPOs are about is less and less about the provision of risk capital for growing businesses that have good ideas. If you take last year, I mean, out of the 20 largest global IPOs, and a lot of this is to do with the US, you'd find that 6 of the companies in the top 20 raise no capital whatsoever. And you'll find that 9 of them were using the money largely to pay down debt. And increasingly, what the IPO market is about is not the way we conventionally think about it, is raising money for good companies. It's about providing an exit for venture capital and providing entrepreneurial owner-managers with a currency for takeover bids and to pay employees with. And that's particularly true when you're looking at the more advanced sectors of economies. Now, the question is, what are the policy implications of all that? And I think if you're looking at the supply side, the things that are discouraging entrepreneurs from accessing public markets, it seems to me that there is now a sort of conventional wisdom that it's sensible to dilute corporate governance requirements to encourage people to come onto the public markets. And I think that that probably is right, but I think there is a very fine judgment about how far you take that erosion of corporate governance standards. Because to give you the most extreme example, Germany. They established the Neue Markt, which was to be a junior market with lower corporate governance standards, and it did indeed attract a lot of companies, and a lot of them had incredibly bad corporate governance standards, and a lot of them went bust. And it was so bad that they had to close the market down. Then there are sort of other sort of possibilities. I mean, you can get to the point where you maybe don't have to close the market down, but if a junior market or any market gets tainted with the label of poor corporate governance, then a corporate governance discount develops in share prices, and companies end up having to pay a higher cost of capital than would otherwise be the case. So I think it's an incredibly fine line that you have to draw to make sure you don't go too far. What is the minimum which is okay before you get a corporate governance taint in the overall market value and a consequent discount? I think if you look at the demand side, the ownership problems that I was talking about, I think there are interesting solutions, and they're substantially to do not with corporate governance, but with the tax system. And I think that one of the nettles that is not being grasped by policymakers around the world is the fact that there is a huge bias in the tax system against equity in favor of debt. And that was one of the many components behind the causes of the financial crisis. And I think that's something where at some point policymakers are going to have to recognize they must address this bias. It's not healthy. But I think that also in the tax system, you can address the problem of ownership and recognize that the natural investors in smaller companies are private investors. Now, we've squeezed private investors out through the process of institutionalization, but you can encourage them back. For example, in the United Kingdom, in AIM, the junior market, there are tax exemptions for inheritance. There is an inheritance tax exemption. That's a sensible way to incentivize people to come back into that market and to give smaller companies a better chance. And then finally, I think I would just say, I think the potential of technology to address this problem of a difficult ownership structure for smaller companies is very interesting. Technology, we could, and I'm sure eventually will find ways of putting investors together with companies in less formal ways, which are helpful in terms of providing access to risk capital for smaller companies where they can't get it from the big institutions.
Thank you very much. Thank you very much, John. David, you used to be the vice chairman of NASDAQ, right? Yeah. the beacon of technology IPOs, right?
Yeah.
But you're not very happy with the way things have turned in the last decade or so.
No.
And what do you have to tell us about first of all, the development in terms of the numbers, but also about the causes? Why are we where we are? And what is the way to get back?
Well, first I want to say, someday I hope to have John's self-confidence to be able to wear a pair of socks like that up on a podium.
It comes with being British.
Yeah, no, I take a stab at how many IPOs we should be doing, because I think it's important to kind of look at those numbers. And John mentioned the fact that leading up to the global financial crisis, that there had actually been a bull market, and we'd come back from the last correction. Well, I call it the bubble rubble, but it was started in 2000, and so we were seeing a resurgence in IPOs. But the number of IPOs, while higher in the United States, was still a fraction of what it had been prior to the dot-com bubble. And so we actually said, okay, look at the number of IPOs. It was about 200 a year, call it in round numbers. And it was 500 a year before the dot-com bubble. And on a larger economy, if we'd grown the number of IPOs at about 3% compounded, which was about US GDP rates, to project out what we should be doing today, you come up with a number of 950 or so IPOs a year. Now that delta, we believe the difference between the 950 and the 150 that we've actually averaged since the dot-com bubble is we believe worth 10 million jobs to the US economy over the course of a decade. It's pretty staggering, and it's very hard to kind of, to put a sharp point on it, but there's a professor, Enrico Moretti, at the University of California at Berkeley, who wrote a book called The New Geography of Jobs, and in it he says that for every technology job created in an economy, there are 5 service sector jobs. There's a multiplier effect. Why do we care so passionately about SMEs? And for starters, all companies start small. Whether it was Microsoft or Intel, they had a starting point. The Microsoft IPO, by the way, that was one of those last public offerings, Hideki. They did one IPO and that was it. They were massively profitable. It was about a $50 million IPO. Intel Corporation went public in 1971. It was an $8 million IPO. The company was not profitable on an operating basis. It was only 3 years old. It missed delivery of its first new product, and the stock was cut down to about what was essentially about a $3 million float value. And because of the different market structure, when they turned the business around, there was heavy aftermarket economic incentives for brokers to get on the phone and sell and replace that stock with smaller investors. Okay, today we have a one-size-fits-all stock market structure in the United States with penny tick sizes. There's no longer an economic incentive to reach most of the relevant smaller capitalization investors. And so all of that secondary and tertiary distribution that smaller companies relied on has basically been decimated. But again, why do we care? We've got poor economic growth in the world, too much debt. We have, in many economies, aging demographics. At the same time, we do have population growth. We do have stresses on the environment, global warming. We've had some real scares in terms of health crises. Look at the Ebola contagion. Look at HIV. We look at you have to ask the question, how are we going to solve these problems? And the answer is, I think, through getting more money into the hands of entrepreneurs, engineers, and scientists. And so what I would call on the OECD and the G20 and the policymakers in the United States is we need to create, and this is back to Vincent's point about right-sizing disclosure, corporate governance. It's not that it's lower corporate governance for smaller companies. It has to be appropriate to them being able to make their decisions and running their companies. It's not less, it's just a different standard. Just like when you look at legislation, you look at regulation, you look at stock exchanges, and you look at corporate governance, that through that group, there has to be a core competency, a discipline around small, medium enterprises and their entire ecosystems to be able to support innovation, growth, and to create the next population of the CAC 40, the DAX leaders, the FTSE 100, the S&P 500, that we need to be able to replant the smaller companies that are ultimately going to grow into larger companies. The vast majority of smaller companies will fail. And to some degree, we have to accept as nations a higher risk tolerance with smaller companies. But as I like to say, that the benefit of great success comes with it a cost of great failure, that you have to be willing to fail. I think the final thing that I would say is that I think that these electronic market structures, this ideology of saving investors money on transaction costs, has been catastrophic to small and medium enterprises. That we're going down a path which academics would call information mining strategies, like exchange-traded funds, where there's nobody left to basically be able to, in that fund, to write a check to put money into a corporation to create jobs. That as we start to embrace lower and lower costs, that it comes, if you will, that the cure, which was possibly excessive transaction costs in large cap stocks, has created a disease, in our view, which is this kind of across the board depression in small company IPOs, and with it goes way down the food chain to smaller and smaller companies, and it's stopping the beginnings of new businesses. In the United States, economist Robert Leighton published in the Brookings Institute in Foreign Affairs in January and February, he documented that the percentage of US corporations that were startups has fallen from about 14% of all companies back in the 1980s to about 8% today. I think those two trends are related: loss of small IPOs and loss of startups. And I'll finally conclude. I wanted to answer a question that you asked at the beginning, Mats, which was about, we've got large pools of capital in private equity and venture capital. Private equity community many times is rationalizing jobs. It's actually a net destroyer of jobs. Cash flow oriented companies. It doesn't start jobs necessarily. Venture capital, which does, as a discipline, and I would ask sort of a rhetorical question: why is it that the National Venture Capital Association in the United States is one of the biggest advocates for changing market structure to better support small companies? And I will tell you that there was a decade there where venture capital returns were 0% in the United States, and it happens to coincide with the loss of the IPO market, the small IPO market. Okay? And there is a belief with some of the major venture capitalists that I speak to in Silicon Valley that if we were able to bring back small IPOs to the level that we had in the early 1990s, that it would actually add 5% return per annum to the entire venture capital industry. As an asset class, of course, that would increase allocations to these smaller companies, which I think is a very good thing. So, to leave you with a thought, we have to create an institutionalized, back to the title of the panel, an institutionalized discipline around the needs of the small and medium enterprise and all the constructs that they require to properly nurture and take the level of activity up across all nations.
Well, sorry. On that note, David, is this on? On that note, David, I mean, you've been in the market for most of your life, and you also work with a very technical and very skilled guy, Edward Kim. And you've had a lot of discussions with policymakers and other folks on Capitol Hill the last few years. And one of the things that strikes me in that dialogue that you're having is when you develop this concept of the ecosystem of corporate finance, if you want. I think, could you just give us a flavor of what you mean and why this concept of the ecosystem of corporate finance is so important for politicians, policymakers, and regulators to understand? What does it do for our economies, and what are the components?
Well, we think that capital markets, that to do them well, there's infrastructure investments that are required, which are every bit as important as bridges, roads, and tunnels to an economy. And part of that greater infrastructure or ecosystem is all of the smaller investment banks that actually do the filtering, the quality control, the disclosure, and then help raise the capital that reach out to institutional and retail investors to place securities and to get capital into those corporations. What happened in the United States is when we went to one-size-fits-all trading markets and we collapsed the trading spread economics and the commission economics through the self-directed competition, that all of a sudden the vast majority of smaller investment banks that were in the IPO underwriting business went out of business. There were, we wrote a paper, you can find it, Google it, it's called The U.S. Need for Venture Exchanges, and we have an exhibit in there which shows the number in 1994, I'll get the numbers wrong, the number of investment banks that did at least one book-run small IPO. And there were, I believe, about 130 and 140, somewhere along that line. And then in 2014, which is the best IPO year since the dot-com bubble, and I'll talk about that in a second, but it's down to about 30. Okay, a massive collapse. That's your ecosystem. Those are your on-ramps to access capital markets. And so what we've concluded is that to have adequate aftermarket economic incentives in a bad equity market to sustain that infrastructure, a minimum economic incentive, is essential to keep this ecosystem alive, so that when we go into a bull market cycle and there is capital raising, that you can get a sufficient number of companies public. My sense is today that if we had the best equity market in the world, we would never be able to produce the number of IPOs in the United States that we could back in even 1990, 5 years before the dot-com bubble. And for me, that is a real tragic outcome of well-intended policies that were meant to save investors money by creating electronic stock markets with low transaction costs. Are politicians
listening to you?
Excuse me?
Are the politicians listening to you?
Yeah, they are. I think our biggest contribution, it takes a village, right? It takes everybody talking about these issues. And as I like to say, the Jobs Act isn't the act that I would have written if they'd given me the pen. But it is, but certainly our work inspired the discussion. And I think the discussion is incredibly helpful. I mean, the thing that I get great pride of is listening to the current SEC chair use some of our language from a number of years ago, like one-size-fits-all markets, calling that into question. Does that make sense? That's a sea change. And I think that as long as we keep asking those questions with policymakers, and the policymakers keep repeating them to us, my guess is that we'll get to a much better place long term.
Thank you. Thank you. From one financial ecosystem to another financial ecosystem. The Shenzhen Stock Exchange is actually a very impressive microclimate, I think, for small and medium-sized enterprises. You have almost like a one-stop shop of assistance and support and services that you provide, and I think that's partly behind your success. But we'll be very eager to hear from you directly what you consider being the important elements and aspects of the Shenzhen Stock Exchange. So, Mr. Chen, please.
Thank you. It's my honor to be here. We have a good cooperation with OECD, and we learned a lot from the OECD. In 2004 and 2009, Shenzhen Stock Exchange launched the SME board and the Chinex board, respectively catering for entrepreneurial and innovative startup businesses. Chinex market is also called Chinese Growth Enterprise Market. Over the past 10 years, we have 1,173 IPOs on the SME board and the Chinex market. The establishment and the well-functioning of the SME board and the Chinex market has facilitated the development of venture investment, eased the financing bottleneck of SMEs, and aroused the passion for entrepreneurship and innovation. Currently, China's capital market is undergoing all-round market-orientated reforms with focus on allowing the market to play a decisive role. I would like to share with you the new developments of China's capital markets and what SJSE had done. Firstly, adopting the legislation-based IPO system to further lower the threshold for SMEs listing. The legislation-based IPO system is expected to be implemented by the end of 2015. Under the new disclosure-centered registration system, the regulators do not judge issuers' asset quality, profitability, and investment value, whether, when, and at what price an enterprise can issue shares are determined solely by the enterprise and the market. In May 2014, SJSE revised Chinex listing criteria, lowering profitability and growth requirements and expanding industry coverage. In the near future, enterprises that are not yet profitable can also get listed on Chinex. Secondly, vigorously advancing transformation of regulatory patterns, reducing ex-ante examination and tightening ex-post supervision and enforcement. In 2014, CSRC eliminated its examination and approval of merger and acquisition by listed companies, so long as the M&A doesn't constitute backdoor listing. This move has created a favorable climate for SMEs to optimize asset allocation and improve competitiveness. As a result, the value of M&A deals on the SME board hit $12.1 billion, up by 350% over the previous year. Meanwhile, the CSRC strengthened inspection and enforcement of irregularities such as illegal information disclosure, insider trading, and market manipulation. In 2014, CSRC imposed administrative penalties on 55 entities and 416 individuals. In the same year, SJSE also reformed the delisting rule. Listed companies that had conducted fraudulent issuance or major illegal information disclosure as recognized by the CSRC will be delisted from the market. Thirdly, enhancing corporate governance of SMEs and strengthening protection of retail investors. In order to improve performance-enhancing mechanisms of enterprises, the CSRC released rules about equity incentive plans and employee stock ownership plans by listed companies in 2006 and 2014, respectively. More than 1/3 of the listed companies on the SME board and the Chi-Next market implemented equity-based incentive plans. In order to step up protection of retail investors, CSRC reformed the system of shareholders' general meetings in July 2014. All listed companies are required to provide electronic online voting mechanisms when holding general meeting, so that retail investors can participate conveniently. The voting results of retail investors at the general meeting must be calculated separately and made public known. At the same time, for companies suspected of major violations, SDSE also introduced a system of compensation in advance of civil judgment to retail investors by controlling shareholders or sponsors in a few cases, which improved the efficiency of remedy for retail investors. Fourthly, enhancing information disclosure system and solving information asymmetry between listed companies and retail investors. Over the past few years, SDSE has taken a series of measures to improve the timeliness and the effectiveness of information disclosure by listed companies. Listed companies can disclose significant events on a real-time basis through the designated website. Companies can disclose information before the opening market, or at noon, or after the closing of market on a real-time basis. Most listed companies can make announcements directly without prior consent from SDSE. In the near future, SDSE will adjust the deadline for disclosure of significant events from 2 days to immediate disclosure so as to improve the timeliness of information disclosure. Furthermore, SDSE has released industry-specific information disclosure guidelines, requiring listed companies in specific industries to disclose industry-related material information. Since 2010, SDSE has developed an investor relationship management public online platform called EasyIR. It's similar with Facebook, to facilitate communication between investors and listed companies. So investors can ask questions through the platform, and listed companies should answer the questions in 2 days. In 2014, listed companies of SDSE have answered 487,000 questions from investors, or an average of 1,335 responses per day through the platform, and thus provided a large amount of decision-useful information for the market and for the investors. Fifthly, developing SMEs stock price indexes and related index investment products, increasing the visibility of SMEs. Recently, SDSE restructured its most important index, Shenzhen Component Index. Among the 500 constituent stocks, there are 301 stocks from the SME board and the Chi-Next market, accounting for 60% of the total, which will help enhance public awareness of SMEs. As the SE also has developed 36 SMEs stock price indexes. There are 19 index funds entirely emulating the above 36 indexes with $1.6 billion asset under management. We are confident that China's capital market will continue to flourish with the advancement of reform, and lots of SMEs can benefit from the trend. But we do face great challenges. For example, on August the 16th, 2013, Chinese stock market suffered a fresh crash due to erroneous operations in high-frequency trading by a famous security company. This calling attention to the security problem of increasing HFT and the potential damage to the market integrity and fairness. Due to high ownership concentration, the interests of retail investors can be easily infringed upon by controlling shareholders. The secondary market in China is very active, and the controlling shareholder or management of listed companies are relatively easy to earn unfair benefits from misconduct in the secondary market. All this problem will undermine investors' confidence and eventually keep the SMEs away from the equity market. I believe good corporate governance and effective supervision should play a key role to support value creation and growth. To sum up, China's experience tells us that we should loosen unnecessary regulation, give full play to market discipline, and provide SMEs with easy access to the capital market. Meanwhile, regulators, stock exchanges, and other SROs can play an active role in protecting retail investors, increasing market transparency, cracking down on malfeasances, and facilitating innovation in products and business, so as to maintain a fair and equitable market and create a favorable environment for SMEs. Thank you. I'll stop here.
Thank you very much, Mr. Chen. That was very interesting, and I would encourage all of you to go to the Shenzhen website, because there is additional information.
Yeah.
And there is also on the OECD website a presentation by the Shenzhen Stock Exchange that you can find if you go for the Tokyo Capital Markets Roundtable, I think the title is, and you will find it. It's a very interesting ecosystem to explore. Gabriele, can I ask you a follow-up question to your introduction about the non-listed companies and their development of corporate governance? And you mentioned the example of Lavazza. Is there any common feature that you have observed in your career in terms of non-listed family firms that introduce good corporate governance practices? Is there anything they have in common? Is there anything that they are facing? Is there anything in the genetics? Is there anything in the environment? Is there any common threads that you can, in your experience, look at and say, this is probably what makes them do this?
Yeah, I tried to think what kind of question you could ask me, but I didn't think about this. So anyway, I tried to answer out of the blue. Well, certainly they are basically good companies in general. They're doing well. They are international. The families that I've been meeting in these situations are families that have gone around the world. So in the end, I go back to what I said before. It's culture. It's education. I mean, these people understand that they are not just complying with the law, with the rule. They do what, best in the world they've seen happening. And they know that, you see, what strikes me in what we are discussing since this morning, even when I look into the OECD principles, it's that they are basically very elementary and very making sense. In the sense we are not creating a scientific formula to manage correctly companies. We just simply say that you have to give information to your board members in order for them to decide correctly, that you have to be transparent with your shareholders, that you have to be remunerating people in connection with the results. So sometimes I tell myself, why didn't I think before what now I've been taught as an extraordinary discovery? I mean, the fact that, for example, now we have to publish the remuneration of managers, but I mean, why shouldn't have we done that 20 years ago? Why did we need it to get to the point where someone told us, look, put in the book? Why a shareholder couldn't know what a manager was going to do? So we have to go back to the simple things. And now these people that you're mentioning are people that in a normal way, they're satisfied with the business they're managing, so they see extremely normal to consider certain parts of the governance that we are now discussing. But I would like to add also one point on something that I heard before. And I am profoundly convinced, if we talk about small and medium companies confronting the financial markets, that absolutely there is not one size fits all, as he was saying, I think, in the sense that here we have small and medium-sized companies. What we have to pretend from them is that they present simple, transparent, clear, and obviously correct financial statements, and that they have certain rules of the game that are calibrated, as it was said again before, not eliminated some of them, but calibrated, because if you have, in my opinion, if you have just one independent, I always thought this in my life, if you have only one independent man in the board, instead of 2, 3, 4, or 65, and this man, when something is wrong, stands up and says, I resign because of this, one man can kill the decision. So the question is, why don't we follow the principle of saying small companies and medium companies, they're great, they're good, but they have to learn to present correct financial statements, and they have to have some key basic rules calibrated on them. On the other side, with the liquidity that exists around today, with the incredible different formulas for giving them equity through development shares, majority shares, I've seen every kind of things existing around. But with market segmentation, when you speak saying the huge institutional investors could never take care of a small company, obviously, and we shouldn't try to have them taking care of the small companies. It's not their business. We have to go into the markets that are good for those companies. He was saying every big company has started being a small company. But when it was a small company, it was not dealing with the huge investors. So, for example, in the Italian Stock Exchange, we have a market, then we have a star market for medium companies doing, rather good governance principles, and then we have an AIM market which allows, more speculative companies to find the right investors. I might be saying a wrong thing, but when I met, particularly in my Institute of Technology, people with good ideas and good rules of the game, they never had any problem in finding money. So let's forget about this thing that the money is not there. Money is there. The problem is that you don't put in front people serious with money they don't want to lose, and companies that present something decent to be mixed. So let's forget about this thing, companies don't get money. Bad companies don't get money. That's the point.
Thank you. Professor Kanda, now that you have developed both a stewardship code for investors and a corporate governance code for corporations in Japan, you have two strong legs to walk on. Do you believe that smaller companies that are now growing up in Japan will be influenced and inspired by the presence of the discussion about corporate governance in Japan and the practices of larger companies when they develop and when they grow and when they go to the market?
Yeah, that's a very good question, and I hope so. I think I have 2 points. Number one, you have to distinguish between very small companies and large companies once again. When I emphasize that it's importance of corporate governance, large companies, small companies, different as you said. I think that the smaller companies should be subject to more generous requirements as a startup. They should be entitled to fail. I completely agree with that. And therefore, I think that this corporate governance principles should be flexible enough, I think, to cover all minimum standards. But I think that the smaller companies should be entitled to be subject to more general standards. That's my general view. On the other hand, the large company, then even though they are not listed, once again, they go back and forth between public market and listed and unlisted, and therefore they should continue to be subject to the whatever the standards you must have. The Japanese corporate code does not apply to small companies, i.e. non-listed companies, and also the code is not applied to listed companies in their what we call mothers and just markets, that is smaller size companies, in the sense that their principles do not apply in a comply or explain style. They are pure soft law, that is to say, if they are not fully complied with, they are not required to explain. So we distinguish implementation between large listed companies and small listed companies. But may I say one more word? Absolutely. More general. I think in listening to the wonderful discussion here, I always thought, perhaps because I'm from Japan, but in many countries, China, Brazil, Turkey, I think the financial system itself is bank dominated. So the financial system has a strong characteristic of bank-centered system. Even if, like Japan, many countries try to develop capital markets, it's not very easy for us to become like US or the United Kingdom to some extent. The United States, the bank system is surprisingly small, perhaps because for the political reason, I don't know. The capital market's very high and well developed. Under that situation, the US people discussing what should be the IPO market and things like this. Whereas in most other countries, including Japan, we try to make capital market large, but still, I have to admit that huge bank-based system does exist. Within that environment, we are discussing whether small companies finance or eco-finance system should be. I think the discussions will be not the same. So from a policy standpoint, you have to decide, you have to at least look at the financial system, whether you can just diminish the banking system and promote the capital market system. In other words, capital market in a particular jurisdiction is quite contingent. The capital market very much depends on the policy as to the bank-based system. And therefore, one side doesn't fit. But I have to say, when you talk about this small company corporate governance capital markets, you have to keep in mind that what should you do with your bank-based system? Whether you have the policy of diminishing it, or whether you have the policy with both bank-based system, capital market-based system coexisting, or whether we should at least try to hope that we will foster capital market system like in the US or in the United Kingdom. That is a very big policy decision which we cannot neglect.
Thank you. Obviously, you're the expert on Japan, but we have one other panelist that knows a lot about Japan, which is John, who's been there quite often, and you even did a TV series about Japan once, didn't you, for Channel 4?
Yes, just after the stock market peaked in 1990, and I said the Japanese economy was heading for serious trouble for a very long time. But,
and as you journalists always say, very quickly. That's how you always start your questions, you know, very quickly. At least they do on television nowadays, very quickly. Do you have any comments on what Professor Kanda just said in relation to the bank system and the more open capital market system?
Well, I mean, I think that he's right in that I think that for most of the world, the US is an exception to a large extent when we talk about these things. But I think in the context of what we're talking about today with small and medium-sized companies, the thing that's so difficult in the way financial structures have evolved is that they have all become extraordinarily centralized.
Right.
And if you look at, for example, the way the British IPO market used to work 50-odd years ago, and we had institutionalization of savings much earlier than in the United States. There used to be a lot of regional stock exchanges, and there were regional stockbrokers who were very good at identifying young growth companies in that particular area, and they had a lot of investment clients, and they put the two together, and you had a very vibrant IPO market. And that all went with the centralization of everything on the London Stock Exchange and with the sort of institutionalization of funds. And the question is, how can you turn the clock back? Now, David is relatively optimistic about what can be done in the US. I'm less optimistic, other than that I think that it may be possible to turn the clock back by looking forward through technology. And I think that's the only way I can see where you can get those sort of natural investors in IPOs, in the private sort of investor sort of market, to come back in where they've hitherto been squeezed out. So I think there is a difference of view here.
I absolutely agree with John. I mean, I think you got to do both. I mean, that's actually what our company, you know, realized, and that's why we started. It's we actually renamed it Wield & Co. But the idea is to try and take technology to reach out to progressively smaller investors more efficiently, to target if somebody's interested in oncology drugs, to make sure that they get the oncology IPO idea presented to them. Because I think I'm a realist, a pragmatist. I don't think we're ever going to go back to, you know, ultra high commissions and high trading spreads in the United States that really subsidize that magnificent ecosystem. But I do think that there's sort of an intermediary place that we can be where, through the establishment of a new form of stock exchange with higher incentives, a venture exchange, for instance, maybe we'll get some of that back. But I think we're still going to need to innovate solutions that, using technology, will replace a lot of what we used to do in a more highly subsidized system.
Thank you very much, gentlemen. I think it's been a... Why don't we give them a hand first, and I'm not going it's been a highly informative session, and some of this stuff is new to, not only to me, but maybe also to some of you. And I would recommend you to some of David's work that he's been doing for OECD. You can find on the OECD website under corporate governance and David Wield, something like that. You just Google and you find him. He's on the corporate governance value creation website, I think it's called. That's where you can find David's work together with Ed. And there is other useful stuff that you can find there as well. We have a recent corporate bond paper that I think is on your binder that is also on that website. And that's work that we have carried out together with Vedat Akirai and his team at the Bogazici University, the Center for Corporate Governance. And that is also in your binders, but also on the web. That's our most recent work. But there is also other, and of course the new principles are coming out in the summer. Also in the summer is a new book by John, which will be called Capitalism, Money, Morals, and Markets. And I was privileged enough to read the very first script, at least of part of that book. And from what I saw at that time, I highly recommend it. as taking a broader view on what we have been discussing today, and that we will be discussing in the years to come. So thank you to all of you for coming all the way from China and from Japan, from the United States, Italy and UK, of course, closer. I thank you very much. We're going to take a coffee break, which will be approximately 10-15 minutes, and then we're going to have a really exciting session on emerging markets, where I believe this city is somewhat of a bridge between Europe and the emerging markets. So that will be very, very interesting. So thank you very much, and thanks to you again.